Okay, let us get back to the indirect method of solving it. What do you do in the indirect method? We take only the P&L and balance sheet, work backwards from the profit out there. So, what do we do in the indirect method? To start off with, we will say the profit or loss for the year. Let me look at this. The profit or loss, the net, that is, I would say in this particular case, I would say net profit before tax and extraordinary item out there. That is net profit before tax and extraordinary items out there. What is the net profit before tax and extraordinary item? We will take always the net profit before tax and extraordinary item out there in this particular case out there. I am just doing a rough text out here in this particular case out there. That is all. So, what do? We add back all non-cash expenditures. What is the first non-cash expenditure? I will add back depreciation. I am adding back depreciation, which is $450. I will reduce all the income and expenditure which are not pertaining to the core operations out there. Let us see interest expenditure. Interest expenditure will be because of a financing activity. So, what I am doing basically is I am adding back that expenditure because I have deducted and arrived at a profit. I have deducted that and arrived at a profit. So, what I am doing? I am saying interest expense does not pertain to operation out there in this particular case out here. So, what I am doing is I am adding it back interest expenditure, that is about 400. Next I will say there is a investment income which is added about $300. Investment income comes from cash flow from investing activity, not here. That is an income which is added. So, your profit will be bloated by that. So, what I am doing? I have to reduce my profit. So, what do you call it as? What do you call it as the investment income? That is, I am just reducing that, and that is about how much is it? $300. Same is the case with what I do is about what is called as the dividend income out there. Dividend income will what happens? It will inflate your profit, but I am looking at operation. It is not part of the operation. So, I am reducing that. So, what is it? I would say this is the what do you call it as the operating what do you call it as the cash flow out there before. This is what we call it as operating profit before, or what do you call it as operating profit before any working capital changes. Operating profit before any working capital changes. What do you mean by working capital? The changes in the current assets and current liabilities, that is what we are going to see. We go back here, indirect method, what happens? There is an increase in the current liability out there by $500. When there is an increase in the current liability, sundry debtors out there, that means what has happened? You would not have received some $500 more out there ideally, like what we did. So, what happens? The profit figure of 3390 will include the total amount of the sale, but out of which 500 you are yet to receive. So, what happens? That is, I will, what do you call it as, reduce the increase in sundry debtors. I will reduce that increase in sundry debtors out there. Debtors has increased by 500. So, what happens in simple terms? The sale is 30,650. Based on 30,650, you have got a profit of 3390. Agreed? Now, if the entire thing was in cash, this 3390 would be the exact cash, that what you would have. But unfortunately, out of the 30,650, is not entirely cash, some part of it is credit. So, that means last year was 1200, this year it has become 1700. So, it is increased by 500. That means out of the 30,650, $500 you have not received. Sir, last year's money I would have received. Yes, you can say last year's 1200 you have received, this year due is 1700. That means what is the net increase? 500. That means that 500 should pertain only to this year. So that I have not received. So what happens? My profit is after taking the 30,650. But $500 in that I have not received. So I am reducing that $500 here. That is all what happens in an indirect method. Next, I look at what is called as my inventory. Inventory last year is 1950, this year is only 900. Last year was 1950, this year is 900. That means what? Out of these $26,000 that is taken as cost of sale, I have utilized $1,050 worth of inventory from my store. I have not bought this entire inventory. There is not an entire cash outflow that has happened. I have utilized from the store what I have. So decrease in inventory. How much is the decrease? So 1050 is the decrease in inventory out there. So what happens? Decrease is that I am adding it to the profit. Why I am adding it to the profit? Because this 26,000 is not a cash outflow. What is the cash outflow? Cash outflow is 26,000 minus 1050 is the cash outflow. So what happens? Your cash flow will be higher by 1050. So I am adding it to the profit out there. Indirect method. Next, what happens out there? That is, I will look at the creditors. Creditors last year was 1890, this year is 105150. That means what has happened? You have paid. Otherwise, how will it reduce? You have paid. That means what has happened? Cash outflow decrease in creditors. How much is the decrease? Last year was 1890, this year is 150. That means 1740 is the, what do you call it, the cash outflow that has basically happened out there. So what happened? Cash outflow happens, it is negative. So what happens? What is the net cash flow generated from operations? Cash flow generated from operations, total cash flow generated from operations is this, is change, plus this is the change in working capital, plus this is the change in inventory, plus this is the change in creditors out there. That is what is the cash flow generated from operations out there. Next, I go to what is called as the, in operation there is something called as income taxes paid. Let me give this as an explanation 1 out there. In this case, what happens out here? Taxes. Taxes for the year, $300. This $300 includes, as we say, tax deducted at source of $40. So what happens? First, let me deduct what is called as, to find out what is the cash outflow, deduct tax deducted at source. So that is paid by you. Yes, that is paid by you, but please note that is not payment which has gone out from you. So I am taking that. So what is the net tax for the year? Net tax payable for the year. Net tax payable is $260 out there. What is the tax payable at the end of last year? Tax payable at the end of beginning of the year. Tax payable at beginning of the year is about 1,000. That means total tax payable is 1260. Total tax payable is so much. What is due at the end of the year? That means you have obviously not paid. So due at the end of the year is about 400 in this particular case. So what is the ideal tax paid? Is the ideal tax paid is so much. The ideal tax paid, tax actually cash outflow due to taxes is only $860 in this particular case. So, cash outflow, that means this is the amount that I have paid out there. Then we see that there is an extraordinary item out there, that is a cash inflow, proceeds from disaster. So, what is the net cash flow? The net cash flow is basically we go here, we add this and then we add this. That means what you call it as net cash flow from operations is 1830. Net cash flow from operations is 1830. So, what did we get in the direct method? Let us open that file and then let us see what did we get from the direct method out there. In the direct method, when we open that file, I am just looking at that particular file, that is direct method. What is the net cash flow from operation? 1830. What is the net cash flow from operation here? 1830 in direct method. So, it does not change, the net cash flow remains basically the same out there. I am going to suppress this and keep. Next, let us look at cash flow from investing. Cash flow from investing activity. What is the investing activity? Investment income. What is the investment income out there? The investment income out there is $300. I am yet to receive, as you can see in that earlier thing, interest receivable, yet to receive 100. So, how much I have received? I have received only 200 out there. What is the dividend income? What is the dividend income? Dividend income is $200 here, yes, but $40 that guy has deducted for tax. So, what have I received? I have received only $160 out there in that particular case out there. I have received only $160 out there. Now, let us go here and then sort of look at it. Cash outflow because of a plant and machinery purchase 350. I explained this earlier. Cash outflow because of PPE purchase is $350, that we saw that last time. And I have sold something. So, cash inflow because of PPE sale out there, that is about $20 out there in this case. So, what is the net cash flow from investing activity? Net cash flow from investing activity in this particular case is $30 cash flow from investing is $30, and that is exactly the same number that we got out there before out here. In this particular case, cash flow from investing was $30. No difference, direct and indirect. Next, I move on to what is called as cash flow from financing. For cash flow from financing activities out there. There are shares issued, there is a debt borrowing. So, let us take both. Share is issue cash inflow due to issue of shares, that is $250. Cash inflow due to new debt is again $250 out there. Now, we have to look at, that is what is called as the net if $250 in the debt 1040. So, what happens? There is some bit of what do you call it as in this particular case out there, the amount of debt that is getting what is called as the repaid out there in this particular case out there. So, what am I going to do out here? Let me see in this particular case, that is the new debt formula out there. What is the debt as per opening balance sheet? Is 1040. What is the new debt raised out there? 250. So, what should have been the ideal debt out there? The ideal total debt at the end of the year, ideal total debt at the end of the year should be so much. But the debt at the end of the year is how much? End of the year is basically how much out there? End of the year is only about 1110. That means what has happened? You would have ideally repaid. Debt repaid is 150. That is repaid, a cash outflow is 180. So, what happens in this particular case? New debt, I am sorry, not here, I would say that is debt cash outflow due to repayment of debt. How much is it in this particular case out there? That is, this is the amount of money that is repaid out there in this particular case. Next, what else have I left out? Any other stuff out there? Let me basically see my book out here in this particular case out there. Let us see. There is what is called as interest expenditure out there. Interest payment is on financing. So, let us do what is called as cash outflow due to interest payment. What is the amount of interest paid? Let me see this as 3 out there. Let me put this as 2 out there, and let us see in this particular case out there. Number 3 part of it is interest. Spelling interest. Interest expense for the year. How much is it? As per the P&L, $400. Now, like go to the liabilities of the balance sheet. Interest payable at the last year is 100. That is, add interest payable at the beginning of the year, $100. That means what is the total interest payable out there? That means total interest that payable during the year is 500. But I see that at the end of the year you still have 238 to pay. So, I reduce it. That is what happens, less interest payable at the end of the year is how much? 230 out there. That means what is the amount of interest that is totally paid? The amount of that is cash outflow for interest payment is, what do you call it as, is 270. So, what happens? Cash outflow for interest payment $270. I will take it here. Cash outflow for interest payment, I will take the $270 here. Then what is happening? There is that dividends paid. I have cash outflow, dividends, cash outflow minus 1200. So, if I basically see this, what is the cash flow from financing? Financing is nothing but this plus, sorry, this plus this plus this plus this out there. Cash flow from financing is 1150. Let us look at, what do you call it as, the other calculation what we did, 1150, exactly the same what we are getting, no change. So, what is the net cash flow? Same thing like earlier, net total cash flow out here, net total cash flow. Net total cash flow is nothing but this one plus this one out here is the net total cash flow. Cash, add cash at the beginning of the year, cash and cash equivalents at the beginning which is which is what do you call it as, if I have to look at out here in this particular case, 25 plus 135 as I have explained to you. So, what is the cash and cash equivalent at the end of the year? 870. As you can see, cash and cash equivalents at the end of the year is 870, and that is what we see, 200 plus 670 and exactly. We have sort of looked at the cash flow from both direct and indirect method. This sort of takes care of that. I think we would have sort of revised enough number of numericals we have done on cash flow, both direct and indirect method. So, they should have got the basics on cash flow perfectly right out there. That sort of takes care of all the three financial statements out there. Thank you.